Hi, this is David of Bionic Turtle. Welcome to video 6C, which is the third of four videos devoted to the credit risk topic in the 2012 FRM. We continue with the study guide, and that means the 5 readings that are part of this presentation all reappear from prior years in the FRM. And frankly, they have various degrees of relevance. So I have a large deck here. It's actually got 100 pages. If you want to download the slides for future reference to cover all the aims, but some of them I'm going to gloss over in pursuit of the more relevant content. So for example, this Linda Allen chapter here is very old, like the De Servigni. Some of these are really like a decade old, obviously before the financial crisis, with some dubious relevance to us in the exam. This extending the VAR approach to non-tradable loans. For the credit risk topic, it's just not going to be as relevant as default risk or credit risk in whole. So I do have learning spreadsheets again as usual, and then the only one here that I've tagged as highly relevant for exam purposes is 6C Merton model, which I've iterated several times. It's been vetted. A lot of customers have taken a look at it. It's been beaten up and corrected along the way, and I'm happy. I think it's in a good place right now to give you on one sheet a summary of the 2 major steps in the Merton model. The first is using Black-Scholes to price the value of a firm's equity as if it were a call option on the firm's assets. So that's the Black-Scholes option pricing model. And then, in terms of the De Servigni, using Merton to estimate a probability of default. Both of those are explored with some permutations and with reconciliation to Stolz. And so this 6C1 really it seems to do a good job of sort of arbitrating any of the concrete nuances or details. And there are some nuances there are some different ways of looking at this. And then we've got 6C2, 3, and 4. 6C4 is the credit default swap valuation, so a really interesting exercise that's in whole. Now I have it as medium, not high, and the reason is that it's not a trivial thing. It's not something you can comprehend in 5 minutes by looking at it. It takes some time, and I do think it's useful, like many of these exercises are. So for example, like pricing a treasury bond futures contract. The exam's probably not going to give you that question from start to finish. But if you work that exercise, you get exposure to 3 different building blocks, any one of which could be tested. So I view the CDS valuation the same way. Will the exam ask you to price the credit default swap the way that Hull does it from start to finish? It's unlikely simply because that would take more time than you're allotted on the exam for a question. It's unlikely for a practical reason. Does that mean it's useless to look at the CDF valuation? No, because the CDF valuation applies time value of money, the discounting concept, probabilities, and it gives a concrete, maybe the most concrete understanding to the credit default swap. I myself personally, I sort of understood the CDS theoretically and reading about it and seeing examples of it. But when I finally processed the valuation of a CDS, then my comprehension really stepped up. Having the quantitative understanding, I really increased my qualitative understanding. So hopefully I've made an argument for how it has an indirect value to you, even as you won't see that question itself on the exam. So Chapter 3, Default Risk, Quantitative Methodologies. Under the Merton model, okay, we really have a simple capital structure assumption. And notice I've got these presented like the balance sheet of a firm, left-hand side, right-hand side. That's the way I think about it. Here are the firm's assets on the left-hand side. And on the right-hand side, we have the sources of